So Alibaba has just recently released their earnings report for the December quarter of 2023, and we are here to investigate what exactly happened, and also to determine whether is it finally time to call it Ali Bye Bye instead. So shareholders of Alibaba in the pre-market was actually led through this entire roller coaster of emotions. Essentially, I think the earnings report that Alibaba has just posted was right around estimates, and it wasn't really mind-blowing to investors. And if I can summarize it in two words, it's basically same old. So if you were to look at the overall breakdown, the total segment revenue actually grew 6% year on year, and the two main important pillar of the entire Alibaba business is Taobao Tmall and Cloud Intelligence. So Taobao and Tmall is actually up only 2% year on year, while Cloud is only up 3% year on year. So this is a very stark contrast if you were to compare it to their closest US counterpart, which is Amazon. So personally, I'm a shareholder of both companies. Therefore, inevitably, I actually monitor both their earnings. And Alibaba, which is an extension of the health of the Chinese economy, is signaling clear signs of weakness. And if to compare the state of both companies, Alibaba really pales in comparison. So with these two critical business verticals of Alibaba underperforming, regardless of how the international segment, their Cainiao logistics, and even their local services arm, whether they post in 10, 20, 30 or even 40% growth, it's not enough to impress shareholders because the entire investment thesis and story of Alibaba relies on them exploiting their current e-commerce business, yet at the same time building that cloud vertical, which is the future. So both has been underscored in the grander scheme of things. Moving on to the bottom line, it's not painting a very pretty picture as well. So income from operations was actually down 36% year on year. Net income is actually down 77%. A large part of this income is being written down because of the amortization and impairment of intangible assets, and also the impairment of goodwill and investments, which we will talk more about it in the later part of this presentation. So moving on to the cash flow profile, it's speaking the same story. Free cash flow is actually down year on year from 81 billion RMB to 56 billion. That said, Alibaba still printed a respectable 7.9 billion USD in the last quarter, and in the trailing 9 months, they actually came in at around 19.8 billion dollars. So a large part of this reduction in free cash flow came in two forms. Number one, it's because of the reduction in cash provided by operating activities, and number two, they're essentially stepping up on their capital expenditure. So I believe one of the most critical factor that led the initial rally in the pre-market was really because Alibaba just announced an upsized share buyback program of $25 billion that was approved by the board. So as of the previous quarter, it means that their share buyback program was at a grand total of $35.3 billion made available. And assuming that the current market capitalization is right around 190 billion, 35.3 billion is right around 18.5% of the outstanding shares. So they can essentially retire 18.5% of the company within the next 3 fiscal year, which was provided by the guidance of the management team. So I believe this share buyback program is just their way of signaling to shareholders that, hey, my cash generation ability is real, my balance sheet is a fortress, and I'm not afraid of rewarding my shareholders. But that said, from a more cynical viewpoint, this share buyback program is basically just acting like a flaw, and it's acting like a drug, trying to resuscitate the druggie. And it doesn't really solve the fundamental problem, especially in the investing space, about where the future of this company is heading or charting towards. Moving on to the next positive. I think that's about it. That's basically all the positives that we have in the recent earnings report. So of course I'm just joking, but the share buyback program is basically the biggest positive headline from their recent earnings. Other than that, I think some of the bright sparks, their international commerce group actually grew 44% year on year, driven by Choice, which is the prime equivalent of Amazon. So their cost structure actually still remains decent as a percentage of revenue. They kept it quite tight at a plus minus 1%. Their balance sheet is still a fortress. They have $68.5 billion in net cash, and using a $190 billion market cap proxy, they have around 36% of market cap. It basically screams as if like Alibaba is preparing to go to war. That's why they're keeping such a huge war chest, which I don't really know why, but I guess that's up to the discretion of the management team as shareholders. So they also went through a retrenchment exercise where there's a reduction in employee headcount of 2.5% quarter on quarter, and they still remain extremely profitable with their cash generative ability, and they are not negative yet. despite all the naysayers and a lot of the fear mongers talking about the end of the Chinese economy and the entire property crisis. Moving on to the negatives, which we have quite a few in this entire list. So I think largely speaking, we are really talking about the core business of Alibaba today. So their growth on multiple fronts actually continues to disappoint, where Taobao and Tmall actually grew 2% year on year. And in the disclosure, they said that they appointed a new management team to execute strategy and drive growth through tech innovation. So many of these are very qualitative guidance, which is not really reflective in the numbers itself. Because if you really want to show that you have tech innovation, prove your numbers like Mark Zuckerberg and Meta. They drive strong growth, they drive strong impressions, and they drive strong bottom line. So they did also disclose that GMV had healthy growth, number of active buyers and order volume grow strongly, but they are offset by the decrease in average order value, which is kind of intuitive because if you look at the e-commerce scene in China today, Pinduoduo had this explosive growth because they're really targeting the lower rungs of society where people are really more focused in getting cheap products and much more cost sensitive. So in this case, it's also reflective in Alibaba's business as well. So CMR, which is customer management revenue, was flat, basically their highest margin business, and the harvesting of most of Alibaba's cash flow and income is from here. And cloud, which is the other important segment, only grew 3% year on year. They cite that it was because of a decrease in revenue from low margin project-based contracts, but public cloud products and services experienced healthy year on year growth rate. So the international commerce did grow strongly, but the cost structure actually bloated as well, where their adjusted EBITDA actually went even more negative to probably fuel their growth plans. Now moving on to the bottom line, their operating margins actually took a hit, where they had an operating margin of 14.1% in 2022 to 8.6% in 2023. And this was primarily due to the impairment of intangible assets of SunArt and Youku. And these are extremely big expenses if you compare it on a year-on-year basis. So just to give you a flavor and context of their operating margin, so this is from the year 2023, starting from the June quarter, June, September, and December. In terms of their operating margin, they actually did show some sort of bottoming out, at 18.15% for the first quarter and 14.9% in the second quarter. But currently in the third quarter, they actually went back down to my rate signal, which is under 10% at around 8.6%. So if you were to compare it in the year 2022, you can see that margins were hovering at the low double digits mark, 12, 12 and 14%. And there was some sort of a bottoming at 7.3% in Q4, which is the March 2023 quarter itself. So we thought that it kind of bottomed and we kind of stabilized back up, but clearly in this most recent quarter, their operating margins is not as ideal. So I guess that's one of the important factor of why there wasn't really a huge beat or huge excitement amongst the investing community. And also, the free cash flow took a hit as well at negative 30% year on year. So it was primarily due to the capex, which is a small effect, and several one-time factors like timing of the income tax payments and working capital changes. But I think in the grander scheme of things, looking at how the trajectory of the free cash flow is growing, I would presume that 20 to 25 billion per year, per financial year is something Alibaba can achieve quite easily. Not barring any strange or freak incidents. And another factor is that Ant Group actually got hit badly. So I listed out the same quarter of the last 3 years in terms of the profitability attributable to Ant Group, and you can see that it's basically a nosedive, and this plunge is pretty worrying. So in 2021, it was around 5.8 billion RMB, 2022 was 1 billion, and 2023 was actually $80 million RMB. So they basically went from 6 billion to zero, close to zero. So in 2022, the reason cited was that there was a decrease in valuation of certain overseas equity investment. So let's not forget, this is profitability. So yes, you do have to write up and write down your equity investment because it hits the bottom line. So Ant Group doesn't really report their revenue, their expenses, their operating income, and then their net income. They basically just report their net income and then what is attributable to the main parent company, which is us as Alibaba shareholders. So from this perspective, it's true that all their investment write up and write down do affect the net income, but that should be one-off. However, this problem is extended by another year to 2023 in the latest quarter, where Ant's net investment loss continued to weigh heavily on their earnings, while operating profit was actually flat. I guess this was their disclosure. So the funny thing, or the red flag in a way, is that for this specific item, when you talk about operating profit being flat, this was not disclosed in 2022. And we know that there's this entire crackdown of Ant Group back in 2020, and the financial regulators actually started stepping in, trying to restrict this and that. So I'm not too sure in terms of the operating profit, because I believe 2023, the operating profit base comparison was with 2022, but 2022's base comparison was not with 2021 because there was no disclosure. So I guess we kind of need to wait for another year to see what kind of disclosures that they put out and what is the profitability trend of Ant Group being attributable to the main company. Long story short, there's no visibility, kind of signals some sort of a red flag. So many people will be asking, is Alibaba still a buy right now? So for me, I think the assumptions for the investment thesis is still the same. For many Alibaba bag holders for quite some time now, we are all hopeful for the Chinese recovery, the Chinese consumption recovery, in fact. And there's just a cyclical nature of boom and bust. And looking at how the entire property crisis is playing out, we are part of this down cycle. And presumably, as China comes out stronger, Alibaba, being the leader in e-commerce and cloud, will continue to pick up in the up cycle. So I guess it's the darkest before the dawn. And whether investors have the stomach for this volatility and many of these bad news being thrown your way. Secondly, I think in terms of a leadership and strategy transition, it has been very painful for the past 2 years. There are many shakeups where Daniel Zhang say he wants to do this, he's going to step down, he's going to focus on cloud, and then he goes missing, and then there's some infighting, and there's really a lot of confidence being lost in the midst of how things have been playing out for Alibaba. And in this case, it takes some time for the company to prove itself again. And the most important barometer for most investors is really the numbers that they're going to produce. And towards the third point, numbers don't lie, and Alibaba hasn't been producing numbers good enough for investors to bite. And with all the many discussions around China being uninvestable, people are scared of China. Look at Pinduoduo. Pinduoduo being in the same industry as Alibaba, they've posted monstrous growth. And regardless of what all these China fearmongers have to say, Pinduoduo continue to much higher, and they've experienced great amount of momentum. So I guess many of this story building is only true to a certain extent. And while on the other hand, let's go back to the basics of investing. People only care about one thing, which is earnings. And earnings is transcribed by numbers. So if you look at it, I think on a few points, Alibaba still remains very attractive with a solid margin of safety and undemanding valuations. Assuming that they can produce 20 to 25 billion of free cash flow per year, they are trading at around 8 to 10 times of free cash flow. And even if you assume that it's a 0% growth company, 8 to 10 times free cash flow means that you are getting around a 10 to 12.5% yield on your investment. So for investors trying to punt for a quick recovery, they might continue to be disappointed because Baba earnings need time to catch up. But that said, this is of course not barring any massive political maneuver of them trying to announce a massive stimulus package, which I believe many people that came into the trade is trying to bet on that huge, massive stimulus. I think point number 3 is probably the most critical factor that's affecting the entire investment thesis and atmosphere of Alibaba today. So the quality of Alibaba is definitely under great scrutiny, and people are very skeptical of whether Alibaba is a value trap or it's a value play, and rightfully so because of a numerous number of factors like competition to execution to strategy to growth, etc, etc. And there's a lot of skepticism in terms of the quality of their e-commerce and their cloud business, and if they continue to stay at low single digits, it's very hard for the market to essentially reprice the business because they are basically pricing Alibaba as a dinosaur company with no growth ahead. And because it's a large ship, it takes time for them to adapt and implement. So I guess this is really the tug of war between the bulls and bears of Alibaba. And I think drawing lessons from the Meta case study, I do see some posts or some people talking about Alibaba having the Meta moment where we know that Meta took a huge nosedive of 70-80% because Mark Zuckerberg lost his way in the metaverse and the core business itself hasn't been performing. And likewise for Alibaba, the core business hasn't been performing. And when Zuckerberg turned on the lever of profitability, that's when all the hype of Meta came back again with all their AI implementations and advertising, etc. I think think there's a slight difference here because of the macro and meta environment. Meta environment meaning not meta as meta platforms, but meta environment is different. Operating in US and the rest of the world versus China, I think we have to kind of stay intellectually consistent. China is indeed in a hard place. And for us to step up advertising efforts and for Alibaba to continue to prosper in a very hard place, it's a tall order. But that said, I think likewise linking it back to the first point again, if we do believe in the cyclical nature of the boom and bust cycle of the Chinese economy and we are expecting some sort of recovery, then it's a long-term play where Alibaba is offering you opportunities to accumulate at the lows, and you have to make the judgment of the quality of their e-com and their cloud business. Presumably that they recover, whether they're able to take advantage of that recovery or not. And on point number 6, it feels like their buybacks now will act as some sort of support as long as they maintain their cadence and they continuously buy back their shares at low valuations. So I think to round up this entire earnings report, there's nothing much to take away from this new earnings release. There was no new revelations other than their commitment to reward those that continue to stay vested. With that, I'll see you guys in the next video, but more importantly, I'll see you guys on the moon. Goodbye.